All right, good morning, everyone. It is 8:44 on the morning of January 3rd, 2023. Welcome to 2023. I hope everyone had a safe and happy holiday season. And so, the title of today's video is VIX up and SPY up in pre-market is a divergence. I'm on the Qs right now, so let me go to the SPY. So if the SPY opened up right now, it would open up 0.55% higher than its previous close. And you can see here last Friday that at the end of the day, there was this nice rally. The SPY opened up and stayed pretty much even for the most part on Friday. Started to dip down, and then the afternoon session came about, and the buyers came in. So here we are this morning. The close last Friday was at roughly 382.5, and here we are this morning, opening up. If it opened up right now, it would open up at 384.5. So a couple points higher, and a couple dollars higher. And we have the VIX that has a 6.6 gap up, 6.6% gap up. And that is a divergence. Typically, when you see the VIX ramp up like that, you are going to see the indices come down. However, the indices have are showing positive or upward pressure in the pre-market. So there's a divergence here. Which one wins? Is it the VIX that starts coming down and the SPY moves up? Or is it the VIX keeps ramping up and the SPY takes another turn down? Well, there's really no way of knowing exactly, really. In my opinion, or in my experience, the first trading day of the year is bullish. So I've been paying attention to the markets, closely paying attention to the markets since 2006. I've only been trading full time for the past three years now, and in my experience, the first trading day of the year is bullish. So my bias is that the VIX will come down, and the indices, the SPYs, the Qs, and the Russell will go up. That's my bias. So let's check out some levels here and see where we are. Now, I don't trade the SPYs very much. I tend to trade the Qs, options on the Qs much more often. And let's take a look at where support and resistance might be on the day. So let's make this bigger. And the first obvious thing to me is this area right in here. This 269.75 looks like sort of the first spot where we got a little bit of support and resistance here back in mid to late December. Kind of weak. Let's see. And then there's this area back here. There's this area back here. Not really seeing anything other than up here. Let's put a line up here. Yeah, right there, which actually corresponds more closely, to that level right there. 280. For the time being, let's see. Did we get technically a higher low? Yeah, we did. So in this support area right here that just occurred, it is fractionally higher than what was put in back here in on November 4th. Let me get the volume out of the way. And that is slightly higher than what was put in back here on the 13th of October. So we have a little bit of support happening down here in this price range. Personally, I think it's just a matter of time until we come back and break down below these levels. However, things can remain bullish up until that happens. bear market rallies can be just rip your face off 20% moves. For example, here we've got this move that went from so the 16th of June, pardon me, up to the 16th of August. So a couple months, 24% rally. Then we've got another one that right back here, let's call it the 14th of March to the 29th of March, 17% rally. So it looks to me, this is just looking at the charts, it looks to me as though the market is trying to put in a bottom here, and in doing so, and actually, you know what? Look at this low over here on the 16th of June. Actually, you know what I'm going to do? I'm going to get rid of this line here. I'm going to put the close. See if I can get it. Yeah, so there's the close on the 16th of June at 268.60. If we hit resistance today at 268.60, I wouldn't be surprised. So essentially, I am, given this sort of short-term pattern going on here, I am bullish. I'm bullish on this move. Now, bearish, it's obvious, really quite obvious, that we are in a bear market here. Did we come off? We didn't come off this bottom support area. We haven't tested this bottom line yet. It's bound to happen eventually. So yeah, for the time being, though, we'll take a look around the horn here. So here's PMI. Says it was reported on the 1st of December. So yeah, I guess that's reported this month. And so PMI, which is a forward indicator, still below 50. That's still bearish. However, it is trying, in my opinion, looks like it's trying to bottom out here. In the short term, I think that'll be a bullish catalyst to see PMI picking back up again. Even though it's still below 50, it's still considered contraction. It isn't moving up. Here we have the 10-year, 2-year spread. Or no, this is just the 10-year. So the 10-year is coming down. There's a little bit of a flight to safety there. When the rates come down, that means there's more demand for bonds, and the cost of the 10-year bond is going up, and so that drives rates down, which is forward-looking. That's a bearish indicator. Now, the 10-year, 2-year spread made a pretty nice little run here. Let's look at that in percentage terms. Oh wow, made a 45.63% run to the upside there. And so that means that the 10-year, 2-year spread was tightening, even though it's still negative and really quite negative. Right now, it sits at negative 635 basis points. So that's really quite a significant spread. However, I'm going to go to the monthly chart here on this. It's not until the 10-year, 2-year spread normalizes where we see the big crashes happening. And the 10-year, 2-year spread can remain inverted for, in history here, anywhere between 12 and 18 months is how long it's stayed inverted, historically speaking. So I think we're in month 7 now. Let's see, 1, 2, 3, 4, 5. Wait, 1, 2, 3, 4, 5, 6. Yeah, we're in the 7th month of the yield curve inversion, of the 10-2 at least, the 10-2 inversion. And that can continue for anywhere between another 5 to 11 months. If history is any guide for the amount of time that the inversion can stay down, the inversion can continue before we see the big crash happen. So it's in my opinion that we are about to see a bear market rally that sets us up for the crash that happens once the 10-year, 2-year normalizes. As it stands right now, let's take a look at where we are on the Qs from the correction standpoint here. So I'll go from the very top here down to what was the very bottom. It made a 37.79% move from top to bottom. Where we sit right now is roughly 35% roughly. So a move up from here that fails to break through the top close here, right up here. Maybe it fails somewhere around here, or maybe it fails somewhere around here, but a sort of a rally to bring retail money back to the table would really kind of be a liquidity event for when the 10-year, 2-year starts to normalize again. Pardon me. So short term, I'm bullish. It looks to me as though we are about to make a move up. In the face, it's kind of called climbing the wall of worry. And then we're going to set up for the next big crash. Which, let's take a look at the Fibonacci's here real quick. I'm going to leave that one up. That one up. I'm going to leave these three lines up right here. So today, a test of 268.76. I think it's in the cards. And if it blasts through that, then it's really quite possible 280 could hit, but I don't think it's going to happen all in one day. I'd be surprised to see it happen all in one day. So let me make those disappear. Let's take a look. Let me get rid of that one. Get rid of that one. I'll get rid of that one too. Get rid of that one. I'll get rid of that one. Get rid of that one. And get rid of that one. So I have these three I'm going to keep. Yeah. All right. Here's the Fibonacci. So what we've done here is we've bounced off of the golden ratio here. The golden ratio, I think, is at 260.11. 260.11. We've come down, we've tested it 3 times. And I like to see things test 3 times. And then what we've had is we've had a failure of this to break down after 3 tests of the golden ratio. Let me put this on the monthly here. So this Fibonacci, the Fibonacci that I have, goes all the way back to September of 2002. Yeah, here to the high in November of 2021. So nearly a 20-year span there on this big Fibonacci. You can see here on a linear chart, things have gone parabolic. And it was time for a correction, and a correction down to the 38.2 Fibonacci looks like a great spot for a bounce. I don't think this is over. I think we still have further down to go, but in the meantime, we could bounce back up all the way to this 75% level, which actually isn't a Fibonacci, at 311.66. And then we could find our way back down here to this. Is that the 50? Yeah, that's the 50% level right there. Eventually, I have no doubt actually in my mind that we do approach that 50% level again within the next 6 to 12 months, somewhere in that time frame, 5 to 11 months, however many months it takes until the yield curve starts to normalize again. We start seeing the Qs really take a hit. But there's time. There's time between now and then, and the stock market, you got to be right on time. You can't be early. You can't be late. So in the meantime, it's looking bullish to me. It looks like we're going to get some support here in this price range, right in here, quite similar to the support we saw over here during August of 2020. That's the way it looks to me. So I will be using my relative strength index strategy, very simple strategy, where I use the 1 minute and 10 minute time frames. So as of right now, the Qs are overbought in the pre-market, and the VIX is coming out of overbought. Yeah, that's the divergence there. So a very interesting thing happening here. my strategy may not work. Actually, I may just be sitting on my hands all day, but I am going to use this strategy. So as the cues come out of overbought, as the VIX, as the cues come out of oversold on the 1 minute and 10-minute relative strength indices, and if that happens in conjunction with the VIX coming out of overbought. So if the cues are coming out of oversold, at the same time the VIX is coming out of overbought, that's going to be a bull. That's going to be a long trade for me. I'm going to go long. I'll probably use strikes. They're about a month and a half out. Let's see, about 2 months out. So that way the price is a bit more stable. I don't, the 2 week out, with a VIX at 23, the premiums extremely high. In fact, the premiums on all options right now are extremely high because of the volatility, the heightened volatility. However, the price on the options will be more stable with a longer duration. And I'll probably try and get in for the week or so, something like that. Here we have Bitcoin. So if things turn bullish, Bitcoin turns bullish. And it is really quite possible to see Bitcoin try and retrace to this support resistance level back here, somewhere in the upper 19,000s. I don't think it makes it quite that far. I think that we'll probably see 18,000 or so before we see the next leg down on Bitcoin. Bitcoin is looking to me like it wants to hit this sort of 13,000 level in February, so in about a month and a half from now. In the meantime, though, it can be bullish. So I don't trade Bitcoin, but I do keep an eye on it as a forward indicator. And so when it gets bullish, I mean, it's just like anything else, on the market. Really, it's all kind of affected in the same way. So, when tech is bullish and the SPY is bullish, Bitcoin is also bullish. All right, so let's see. Let me put my horizontal lines back up. Yeah, so in fact, I might actually even be able to make a bear trade today if we hit resistance here at 271.39. That's what that number is. If the Q's bump its head against 271.39 and then starts coming back down again, then that could be, if we do something like this, break above and then break back down, retest and then break down again, that's a bear trade right there. And that might be the trade for the day. I'm going to have to just kind of play it by ear. I'm going to have to see what happens. Because then if it starts breaking down again and then starts coming out of oversold, the Qs start coming out of oversold at the same time the VIX comes out of overbought, then that's a bullish trade. So that's pretty much going to be my strategy for the day. See it hit resistance, maybe even break above, then come back, retest, and fail. Then there's a bear trade there. In the meantime, though, if we open up and we dip down, suppose we opened up at 268 where we are right now, and it dips down and then breaks back up above, then that's a bull trade, regardless of where the relative strength indices are. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. I will see you at tomorrow morning's strategy session. Thanks for tuning in. I am out.